Interest rates on Treasury bills have been declining for 6 consecutive weeks as the Central Bank of Kenya, CBK, actively works to drive rates lower amid an improved economic environment, including low inflation. What does this portend for investors and the CBK's monetary policy decisions moving forward? Oladipo Ajayi, head Fixed Income and Forex, Chapel Hill Denham, joins me for this. Thank you for joining me today.
Yeah, thank you very much for having me.
Right. We see a marginal decline in Kenya's T-bills interest rate. Can we sort of draw, beg your pardon, can we draw a connection between the decline in rates and an improved economic environment, of course, including low inflation, or are there other factors responsible for this?
Of course, you have just mentioned the exact reason. Low inflation is one of the factors because when you look at Kenya economic environment, the CBK actually set a 5% like a corridor or a target for inflation. Currently, the last inflation for the month of October printed at 4.4, although like 10 basis points are higher than the previous one. But it's still within the range of what CBK is actually working towards. And also the good part of it for them is that they are not so much pressure on the economy currently because we have seen most developed nations now, aside the United States, has actually cut interest rate. We've seen that in Eurozone, we've seen that in UK. We also saw that in Canada as well, which also lent credence to the fact that the current economic environment require low interest rate in some of those clients. And we expect the US Fed to also hold the line coming this month. So we feel that exactly what is happening in most of these advanced nations also having a tool on some of these emerging markets, and that's exactly one of the reasons why we have been seeing marginal rate in return of Treasury bill for investors.
Investors cannot leave their monies idle, so where is the money going?
Of course, it doesn't mean that there's still no room for investment, but just that the interest rate you enjoy cannot be compared to what you used to enjoy. Because when you look at 1 year paper, it's still printing above 16%, and maybe not as high as what it used to be. Let's take the Nigerian market, for instance. At the point in time, 1 year paper was printing about 22%. But currently, if you look at what happened at the last NTB auction, you will also agree with me that rate has dropped close to about 350 basis points. And but does that mean that there's still no investment opportunity there? Of course, there is. But just that if you are taking that decision earlier enough, you'd have been able to make a better return. And that's one of the reasons why in high interest environment like this, it's better to actually go into long-dated instruments than short-dated instruments like Treasury bills. If someone has invested in like a 5-year, you continue to enjoy this level of return for a period of 5 years compared to when you invest in short-dated instruments like Treasury bills, because you're actually exposed to investment risks at the maturity of such investment.
Right. I was saying, beyond the fixed income markets, are we seeing activity in other markets, maybe the equities? Do we have opportunity there when you look at the Kenyan NSE?
Of course, there's opportunity in the equity markets. When you compare what's happening in emerging markets with what's happening in global markets, of course, it's a situation whereby you start seeing interest rates dropping. What the next level of movement is that most investors will actually move from the fixed income market to more of equity market, and that's exactly what will be the next line of action. And because mostly what investors look at is the dividend yield. You look at what is the dividend yield of most of these instruments in the equity market, and as well, you compare to that what like a 1 year paper is currently printing. And when you look at it, you are able to make a good decision around that. So the next line of action that we feel will happen most times is that we'll start seeing migration from the fixed income space into the equity space. And what that will mean to investors that are already positioned in that market is they will be able to enjoy not only dividend income, they also enjoy capital gain, which will also come as a result of appreciation of the valuation of the investment.
That was earlier when you talked about inflation in August, being 4.4%, while the one in July was 4.3%. But then looking at that, Although you can say it's still within the target range, do you see it impacting CBK's decision at the next MPC meeting? Because, I mean, that's where all of this actually start from.
No, I don't think that will actually lead them to do that. Because even with their target is that they're already working around to start lowering interest rates. And don't also forget that as much as you're looking at it from the angle of investment, you also need to look at it from the angle of borrowers as well. Most companies have been finding it very difficult to borrow in Kenya because of the high interest rate environment. So now with what is happening, so it's more like a good news to them. Manufacturing companies will be able to actually borrow lower than what they used to borrow. And what that would mean is that will reduce their finance cost. And at the end of the day, that will impact their bottom line, which will also bring more like a better dividend yield to investors in that phase. So it is not totally doomed for investors because if you are losing something in the fixed income side, you can also gain it, take a gain from that as you move into the equity space. So for me, I don't think I expect CBK to be hawkish in their direction currently. Knowing fully well that the advanced nation, they're already toning down their hawkishness. So in the same manner, I feel that the Kenya Central Bank will look at a way to actually reduce rate rather than looking at a way to actually further increase interest rates in the environment.
Well, so do you expect the current easing of rates to be sufficient to sort of ignite, private sector performance? Did I say performance? Private sector growth?
Of course, because one of the things that has been stifling private sector growth is basically because of the high interest environment. And what is happening in Kenya is synonymous with what we have in Nigeria. The only difference is that Kenya has been able to narrow their inflation within their target rate, but Nigeria is still struggling to be able to put that into within target rate. So the fact that Kenya has achieved that, they've been able to actually bring inflation down. What it will mean to them is that the next line of action is to start looking at how to actually further grow the economy. And one of the best ways to grow the economy is to actually drop interest rate, because when you drop interest rate, it will actually spur growth. And how that will happen is that people will borrow. Companies will be able to borrow, production will increase, productivity activity will increase, people will borrow to consume. And these are some of the things that will actually lead to economic growth. And I think that would be the left line of action for CBK currently, knowing fully well that they've been able to actually bring inflation down to a reasonable level.
I'm just wondering, and in my head I'm thinking, where will Nigeria be able to also bring its own inflation to that level? I mean, give us an idea. When can that happen, or when will that happen?
Well, you cannot really say it currently because a lot of things are still happening in Nigeria that we need to allow the volatilities to settle. Currently, we are still not be able to resolve the issue of PMS price. And you don't want to get to a situation whereby you have set a price and you come and set another price. What that will mean is that will continue to actually impact on inflation. And just remember, sometime in August, when the result for July was released, it was as if we are getting towards the end of the tunnel, and it was as if we already see the ray of light. But with the new change in payments, of course, that's also now changed the trajectory of things. And because the new information, what it would do is that you need to actually recalibrate your model. And what simply means that it's not a time to celebrate yet for this inflation. And because this will also impact inflationary pressure. And so these are some of the things that we need to actually settle for before we can now say, oh, this will look more like the timeline that we can now see inflation actually dropping aggressively. At the time, our inflation corridor has always been between 9 to 11. And I remember during the time of SLS and the CBN governor, the corridor has always been around 9 to 11. So it means that when inflation goes above 11, we feel that there has to be aggressive policy from the monetary policy guys. And for a long time, we are around 9% level, even we are at sub-9 level. I think we can also still get back to that level. We just need to actually clear what is currently on ground, ensure that the structures are working, and we'll get there.
Close on this. Give us, an overview of the broader market trends in Kenya. We'll close on that.
Well, the broader market in Kenya, currently, like we still, the fixed income market still look more like like the to go for a lot of people currently, and because 60% for a 90-day instrument, a 182-day instrument, it's not bad for a nation that inflation is at 4.4. If you look at the return, the real return is not about 11%. That's about 1,100 basis points, and it's a very great one for anyone still trying to come into that environment. And the equity market is also currently we'll be seeing more like an up and down, and it's basically more like what is happening in the emerging market. Because there are times you see foreign investors actually playing aggressively in the market, and at times you see them coming to the market to actually shell down some of their exposure. And I think that's exactly what we are still seeing in Kenya as well. But all in all, Kenya market is more like one of the best destinations for foreign inflows to the emerging markets. Because when you see a nation where inflation is at 4.4, it looks like the number one market in the African clan. But one thing about it is the fact that the market is not so deep enough to actually absorb that level of liquidity that some of these foreign investors will be bringing to their market. And that's one of the reasons why the Egyptian market, the South African market, and also the Nigerian market actually rank above the Kenyan market in that regard because of the level of liquidity.
Thank you so much, Oladipo Ajayi, Head Fixed Income and Forex, Chapel Hill Denham, for your time and your thoughts on the show today.
You're welcome. Thank you very much for having me on.